From New York City for our audience worldwide, I'm Jonathan Ferro. Bloomberg Real Yield starts right now. Coming up, a decent payrolls report helping to reduce investor anxiety after a run of weak economic data puts investors on edge, driving Treasury yields lower and pushing high-yield spreads wider. So let's begin with the big issue. Does a decent jobs report change anything at all?
It didn't actually change anything in terms of the assessment.
It wasn't as bad as it could have been.
This is a muddled middle sort of report.
A muddle-through type of report.
A bit of a mixed bag.
Employment growth is decelerating.
It is consistent with some slowing.
The economy is slowing.
The manufacturing slowdown is continuing.
But it's happening at a very gradual pace.
We're slowly pressing on the brake here. It's not a falling out of bed moment.
It's not like a flashing red, the economy's falling off a cliff number to me.
Definitely not falling off a cliff.
It's not enough to do anything.
The market's pretty much fully still priced in for an October rate cut.
We have to pencil in a Fed cut in October.
For those who are looking for a decisive message, a deterministic one, they didn't get it.
Joining me around the table to discuss here in New York, Oksana Aronov of JPMorgan, Lisa Hornby of Schroder's, and Gershon Distenfeld of AllianceBernstein. Guys, I want to begin with what changed this week for all three of you. Did anything change for you this week, Oksana, given all the data we had throughout the week so far?
Nothing's really changed on the economic backdrop. I mean, we did have a weak ISM number there, but then we had sort of an on-track jobs number and a revision, an upward revision for August. And we've been in this trend for a while now where the revisions have been up. So it's kind of a weird, environment that we've been in where the unemployment picture continues to be strong. And in terms of the Fed, the probability of a Fed cut actually went down slightly, I think from around 90% to about 75 or so. But again, the Fed is continuing to walk a really tight rope here. The economy is continuing to, you could call it slow down, or you could call it kind of continue to grow at a slower pace.
Yep.
Does it warrant a return back to extraordinarily accommodative measures? We think not, but the Fed is caught in a tough spot here.
What's your take, Lisa?
I tend to agree with everything Oksana said. I mean, our view has been for a while that the U.S. is going to slow from the previous pace that we saw. Last year was clearly taxed induced growth. We've come down to closer to 2% this year. Our view for the rest of the year is 1.5 to 2, give or take. So this is exactly what we're thinking. Manufacturing is clearly in a recession. That's a global phenomenon. It's not aided particularly by what's going on in trade in the U.S., but everything else seems to be fairly stable. Yes, we had the weak service number. We have to see if that continues. But for us, this is more of a 1.5%, 2% U.S. economy.
That was the story coming into 2019, Gershon. Many people forecast that we would return to trend growth. We are arguably doing that right now. Many people also said payrolls growth would decelerate. We've arguably seen that over the last 12 months as well. Yet when you get punched in the face by a growth scare, you get gripped by end-of-cycle dynamics, end-of-cycle anxiety. What's your message for people that are going through that right now?
Well, I think it gets back to what did we learn this week? So we learned that manufacturing is a lot weaker than we all thought. Maybe it's not a matter of, we're going to have a trade war, not have a trade war. Maybe all the uncertainty, because we don't know what tomorrow is going to bring under the Trump presidency, businesses, CEOs, they're not confident to spend money. The $1 million question, or the $1 billion question, is really, does it spread? Does it start to spread to the consumer? Payrolls today aren't going to tell you anything because that's going to be a lagging indicator. The other thing I think that we did learn this week, and maybe this is where I might disagree a little bit, is despite what the market's saying, I think this ensures the Fed's going to cut in October. If you listen to what Chairman Powell said last time, he said he felt like they were good for right now. There was no reason based on what they knew to cut further, but they were going to react and consider the incoming data. I think this is a very clear sign that they're going to continue to cut.
There's a little bit of tension out there at the moment, though, Gershon. The data certainly says maybe now you should be cutting again. But listening to the officials through much of this week, and we close out the week with Chair Powell, but through much of the week, the officials not really showing their hand here. Not really showing their hand here at all. What gives you the conviction that in October, at the end of this month, they make another move?
Because it's what they said. Remember, they didn't say that it's not clear if we actually go into a recession. I hate using the word recession because I don't even know what that means anymore. But if we have a protracted slowdown, let's say, it's not clear how much leg room they have using conventional policies. Maybe they go to QE again. But what they have said is they think that being preemptive can avoid a slowdown. And if they're starting to see weaker numbers, even if it's in only a little part, they're going to say, well, we don't know if it's spreading to the consumer. We might not have that data anytime soon. As an insurance policy, we're going to continue to ease.
Oksana?
Well, of course, the problem with being preemptive is that we've seen it not work. across the pond in Europe and in Japan. And that's really the issue. The big issue is that is the Fed really frittering its ammunition away for a time when it may need it and it won't have it. In terms of consumer confidence, that's a really important piece, and that's a piece we're watching very closely because, of course, the U.S. consumer has been sent endlessly, 70% of the U.S. economy. And now what we're seeing is, the University of Michigan Consumer Sentiment Index is starting to move down, CEO confidence is starting to move down, business confidence is starting to move down, in spite of some of the economic, positive surprises, frankly, that we've seen. So if you look at some of the economic surprise indices, they've actually trended up, but consumer and business confidence is trending down. So this is a really kind of tough rope again for the Fed.
Although we have a little bit of a disconnect, right, between the survey data, the confidence data, and actually the hard data. So when you look at the hard data, retail sales, for example, last month was extraordinarily strong.
And that's consistent with strong employment, right? So when employment continues to be strong, we're going to continue to see strong retail numbers. But certainly consumer confidence is really important. And we've seen it also hit across the pond where, the savings rate is starting to move up to pre-crisis level in Europe, in spite of the fact that rates are negative and consumers are not really gaining anything from putting their money into.
To be clear, I don't think the Fed necessarily should cut. I'm just listening to what they've been saying. I agree. There's definitely a danger that you get into the point where, where Europe is, where Japan's been forever, where you either have to go unconventional or you have to or it will be too late.
We need to have the will-won't conversation, not the should-shouldn't. And let's have the will-won't conversation. The bond market quite clearly picking up on the idea that they're taking another step towards a rate cut. The bull steepener through this week, Gershon, just the massive outperformance we saw at the front end of the Treasury curve. What did you think about that? Because if I thought we were going to get some really bad data this week, I would have thought duration would have done pretty well this week. I would have thought we'd see a bond market move as well. I did not think that Treasury yields would do what they've done and bond yields would do nothing through the week, pretty much unchanged over the last 5 sessions. What do you make of all of that?
Well, it gets to the discussion we've been having for a long time. Is it justifiable that bond yields are so low? Do you really think that you're either going to go into deflationary spiral or you're going to have negative real rates and no inflation for the decade? I thought the more interesting thing in the U.S., though, was the implied break-evens and tips, which hit a 10-year low of, I think, 147 earlier in the week. So basically, essentially, rounding error, you're sort of zero inflation, a zero real rate baked in for the next 10 years. That's a very pessimistic sign. And I continue to think that one of the markets is wrong. Either the Treasury market's wrong or the equity markets are wrong. If we're really going to not get any real rate of return, we're not going to get growth, we're not going to get inflation, equities are way too high. If things are going to be fine, yield should be a lot higher.
If you had to take some optionality on one of the outcomes right now, if you had to have a base case, what would it be?
I don't know if I should say this, but I think our base view is that we're gonna have a slowdown here. I don't want to use the word recession again, because I don't even know what it means. It's going to be a protracted slowdown. The Fed's probably going to eventually have to react. And I don't know, is that really a bad thing? We're 11 years into an expansion. I get it that, like, in theory, right, central banks, monetary policy is supposed to keep the economy as level as possible, but that's really only in theory. We haven't repealed the laws of economics. There are shocks all the time. And, I probably shouldn't say this, but maybe a little mini type recession, slowdown, whatever, clears out some of the excesses, some of the businesses that have been formed that shouldn't exist, and sets us up for a better path for the next decade. I wouldn't rule that out.
You use the word. You're just calling it a mini recession now, whatever that is.
The R word is a very dirty word at our firm. We don't like to use it, and we don't even know what it actually means. It's like we pretend like there's this line. How we define it? 2 negative quarters of negative GDP doesn't even apply internationally because China's still growing. You're not going to get that on a global growth. But it's like, all right, if we are a little bit to the left of this line, it's a big problem. A little bit to the right, we're fine. That's not how it works. It's a continuum, and that's what we're seeing right now.
Couldn't agree more. The fact that you can go into a shallow slowdown or a mini recession has become anathema, and markets kind of cannot get rid of this binky, and they keep going back to the Fed and other central banks like, rescue us, make this go away. And the reality is that you have to go through a business cycle. That's the healthy thing to do. And on rates, you're absolutely right, Jonathan. We're seeing perhaps the limits of central bank policy because not only have U.S. rates not really, or the bonds have not really responded dramatically. If you think back to when the ECB threw everything in the kitchen sink a few weeks ago at the market, it opened up the purchase program to $20 billion, lowered the deposit rate. Bond rates are actually higher today than they were at that point in time. So perhaps we're seeing kind of the limits of central bank policy, and that's important for portfolios, right? Because let's bring it back to what's happening in portfolios. Portfolios are chock full of duration. That is entirely interest rate risk. It moves entirely on what happens to the 10-year here. And I think the return potential here is extremely limited.
Final word, Lisa.
I think that there's a floor on bond yield. That's what I was going to say right before you jumped in, is that the ECB basically said they're done with monetary policy. There's nothing more that they can do, which kind of puts a floor to where they can go. Yes, they hit negative 80 basis points, but you know, negative 60 is still an unreasonable level, in my opinion. So, you know, I think we're kind of reaching the end, and now you're starting to hear talk about more fiscal stimulus. Even in Germany this week, there was talk about dropping the black zero, the ability to have any sort of budget deficit spending, I think we'll hear more about that in the coming weeks and months, because we need to move into a world of fiscal. I think that's what people are coming around to, and
I think a lot of people agree with you too.
I think that's negative for bond yields.
Guys, you're going to be staying with me around the table. Coming up on this programme, the auction block, the primary market remaining open despite a week of volatility. That conversation is coming up next. This is Bloomberg Real Yield. I'm Jonathan Ferro. This is Bloomberg at Real Yield. I want to head to the auction block now and begin over in Europe on the continent, where the fourth quarter got off to another hot start. Greek phone operator Wind Hellas became the latest junk-rated borrower to capitalise on investors' hunger for higher yields, selling debt to pay its owners a dividend. In the US, issuance of corporate investment-grade bonds was more subdued, with under $10 billion sold so far this week, a stark contrast to early September's heavy volume. And in high yield, the market shrugging off concerns about an economic slowdown. 3 deals pricing on Wednesday alone, including a well-received CCC credit from Allianz Holdings. Sticking with corporates, credit finding some relief in the payrolls report, but not before high-yield bonds recorded their longest losing streak of 2019. Allianz's Mohammed Al-Arian weighing in.
When you get to really low spreads, and especially when the risk-free asset is low, at some point, and the investors say, I'm not getting compensated for default risk. And then you get a blowout in spreads, and then you look at high yield relative to every other asset class and you say, wow, that is attractive. And what's underlying that is that shift between absolute and relative mindsets. And I think that's going to continue for a while.
Weighing in around the table here in New York, Oksana, Aronov, Lisa Hornby and Gershon Distenfeld. Gershon, I want to begin with you. The third mini scare in markets so far in 2019, and high yield just captures it perfectly. If you look at US high yield spreads, the floor through the year really in at around 350, the top, the ceiling, in at around 450. Is this scare any different to the previous 2 scares we've seen through 2019 so far?
Well, other than what we talked about in the last segment about perhaps a weakening economy, I don't think it's any different in that investors keep on coming back to they need yield, and it doesn't seem like the bottom is falling out. There aren't a lot of defaults. That's what's going on at the surface. You dig a little deeper, and you actually see a bifurcation. You're seeing if there's a good, solid double B deal, it flies off the shelf. Live Nation priced a drive-by on Wednesday when equities were down at 2% at 4 3/4. It was oversubscribed and traded up in the aftermarket. Then you had a deal like Shutterfly earlier this week was marketed for 2 or 3 weeks at 7.5%. There were no buyers. It finally priced at 8.5% and traded down in the marketplace. So investors are willing to buy things that they might not have the greatest yields in the world, but it's a lot more than risk-free yields, and they feel good about it, but they're not willing to step out, given where we are in the cycle, and buy the riskiest stuff.
Isn't that the biggest difference between now and Q4 of last year? December 2018, the primary market just shut down. The idea that we got some of these deals done on Wednesday, when the equity market was falling out of bed and everyone was freaking out over an ISM, is that encouraging to you, Gershon, that this market's still functioning?
Well, it's definitely encouraging it's functioning, but the reality is that investors are just showing, again, the need for yield. That's not going to change until it's not just the news cycle. So they might pause for a day or two.
Yeah.
Mutual funds have a lot of cash. Money is still coming in. And that's just not going to change until either it's apparent that we're in the R word, I don't say it anymore, or
the mini R.
The mini R, right? Whatever that means. Or we start to see losses and defaults, which we just haven't seen yet.
Oksana?
So on the surface, we have a tremendous amount of inflows year to date into high yield, about $15 billion, and that continues to support the asset class. As Gershon said, this tremendous need for yield. But if you look under the surface, certainly you're starting to see some red flags, at least red flags for this price level, right? Because everything is price dependent. And what you're seeing is that the default rate in high yield is starting to come up about 2.5% at this point. Last year it was at about in the high ones. You're starting to see very low recoveries of the defaults that we have seen have been coming in at about 36 cents on the dollar. And a very interesting dichotomy has developed within the high yield market where triple Cs tend to lead on the way up and on the way down, particularly in double-digit years, and this has been a double-digit year for high yield, and we're seeing that diverge. So in the third quarter, triple Cs were solidly negative, down 2 to 3%, and the double B in the higher part of the market, high-rated part of the market, was very positive. So that is a bit of a warning sign to me, because typically, whether you look back at 2016 or 17 or pretty much back to history, triple Cs tend to be the first one's on the way up and the first one's on the way down. The dichotomy that we have broadly in fixed income, in fixed income is that you mentioned equities versus bonds, but what we have within fixed income is credit spreads are saying everything is great, and rates are telling us that the check engine light is on, so to speak, right? So one or the other has to dominate. Either rates are right and then spreads have to widen to reflect the R word or the slowdown, or credit spreads are right and then rates have to come up to meet kind of the sentiment that, look, everything is fine.
To put you on the spot then, what's your base case? What needs to happen?
We think that everything across the board is very, very richly priced. So even the things that perhaps fundamentally are not terrible, and certainly we're not seeing anything terrible from a fundamental standpoint, but pricing is very rich. You know, double Bs in the 200s, no thank you.
Lisa Hornby?
Yeah, I mean, you look at the ratios, double Bs to triple Bs or double Bs to triple Cs. I mean, that is the most expensive point that you could possibly find. So for us as multi-sector investors, we are staying away from high yield at the moment. Our high yield dedicated portfolio managers have more investment grade than they've had in a number of years. So we're looking more towards the investment grade, higher quality. You know, I think we were discussing this last time I was on your show, 450, 430, 450 has been a buying opportunity in high yield spreads. This time, I think it's a little bit different. We are in a more uncertain economic backdrop than we were before. You know, the vulnerabilities have clearly increased in the U.S. I'm not going to use the R word. I don't think we're headed there.
Everyone's so scared of the R word around this table.
You know, it's not a binary situation. It's not either we're on or we're off. It's a slowdown. But in a slowdown, you want to start to avoid and become more defensive and liquid in your portfolio.
Gershon?
There's a lesson here for investors. The world is delivered to you. Either you're buying a credit fund that focuses primarily on high yield, or you're buying a duration fund. And the credit people are never going to tell you that high yield's not a good place to be, and the duration people are never going to tell you shouldn't buy duration. That's why I'm going to say the same shameless plug I said last time. ACGYX, we balance the half of its credit risk, half of its rate risk. Given that we don't know which one is mispriced, balancing the two together is a very smart strategy. It's just not the way most people invest.
The problem is both of them are viciously overpriced right now. And, you know, betting on rates to go from all-time lows to new all-time lows is a gamble. Like, no one knows. Markets have gotten this consistently wrong time and time again. So today, when the curve looks the way it does, and you can still earn 2% on the front end of the curve, and the 10 years offering you 1.6 with a ton of duration risk. You know, I hear trades like, you can buy Japanese bonds and then, like, hedge them back to the dollar. And after all these three-legged trades, you end up with the rate of U.S. cash, essentially. And why would you take all that risk? So
you're returning your investors' money.
So we are being very cautious here and focusing on safe carry. And a big part of that are liquid floating structures. And you can continue to be there and clip a very conservative coupon and be ready for volatility, which is coming, because what's going to bomb everyone out at the end of the day, rates and credit, is math. That's the new word I'm introducing here, because fixed income is a mathematically bound asset class, and we are getting very close to those bounds.
Oksana, Aronov, Lisa Hornby, Gershon Distenfeld sticking with me. Still ahead on the program, the final spread, the week ahead, featuring another round of US-China trade talks. That conversation just around the corner. This is Bloomberg Real Yield. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. Coming up over the next week, a ton of Fed speak for you, including from Chair Jay Powell. Through to Monday, we get PMIs out of China, followed by another appearance from Chairman Powell on Tuesday. On Wednesday, the Fed releasing minutes from its September FOMC meeting. And on Thursday, it is the main event, US-China trade talks resuming in Washington. For a quick final word from everyone, Oksana, Aronov, Lisa Hornby and Gershon Distenfeld are still with us. Gershon, what are you looking for next week from the trade talks?
Obviously, I'd rather they go well than not go well, but I just think what we learned from manufacturing, as I said before, is I think the confidence that we have a coherent policy, that it can't just change on a dime, is there. Not to mention, I don't want to talk politics here, but the impeachment talks and who's going to be the president, what's going to happen in the election in 2020 is going to weigh on just the uncertainty. Does not bode well for people making long-term decisions.
Oksana?
Not expecting much of anything at all. It's going to be a continuation of the current kind of one step, forward, 2 steps back. There's really no incentive, I think, on the part of the Chinese to do anything more here. So focus on the economic data, and that's what's going to drive the markets.
Lisa Hornby, your take?
I wish that I could say something that hasn't already been said by these two, but obviously we want something positive to come out, but we notice that whenever something positive comes out, we get something bad. Last week it was restricting capital flows into China. So I don't have particularly high hopes. I think that if something definitive and concrete, maybe a mini deal did come out of it, that would be tremendous for markets.
A mini deal ahead of potentially more tariffs in the middle of October. Do you think those tariffs in the middle of October are avoidable at this point?
We've seen that anything is possible, right? There was the time a few months back where we were talking about putting tariffs on Mexico, and then over the weekend it was going to happen on Monday, and they got rolled back on Friday, I think it was. So certainly anything is possible up to the last minute. I think that the president is trying to use these various negotiating tactics. I think he feels that he's in a more perilous spot given the impeachment talks and given the fact that the one main thing he's had is a very strong economy. I think that there's starting to be some recognition that things are slowing a bit, and I think that you're hearing a little bit more of that out of the White House, which could potentially mean that they're more willing to do some kind of a mini deal to say, we've done something, and stop the investment bleed that we've seen this year.
Trying to read the political tea leaves, it's a tough one, isn't it? Guys, we'll get to the rapid fire round now to wrap up the programme. You know how this works. 3 quick questions, 3 quick answers. End of October, Fed meeting. Is there another cut? Yes or no? We start with an easy one, I think at least anyway. Gershon, yes or no?
Yes.
Oksana?
Yes.
Lisa?
Yes.
Spread widening in US high yield. Do you buy, like you should have bought over the last 2 times through 2019, or is it different this time? Do you buy, or is it different this time? Lisa?
No, don't buy.
Oksana?
Not cheap enough, don't buy.
Gershon?
It's not a buy in the long term, but it will be in the short term.
Final question for you all. German 10-year US spread has narrowed quite a lot this week. We have around 200 basis points. Is that spread going to be wider or narrower by year end? Wider or narrower? Lisa?
Narrower.
Oksana?
Wider.
Gershon?
Narrower.
Guys, we've got to leave it there. Oksana Aronov, Lisa Hornby and Gershon Distenfeld, thank you very much. From New York, that does it for us. We'll see you next Friday, same time, same place. This is Bloomberg.